As we head into the weekend, the U.S. markets are closed for trading on this Saturday, October 25th, 2025. But the conversation around SoFi Technologies, ticker SOFI, is anything but quiet. The stock finished the last trading session on Friday, October 24th at $29.01. That was a very strong move, closing up 93 cents or 3.31% on the day on robust volume of over 53 million shares. This stock has been on an absolute tear, more than tripling from its 52-week low of $8.62. And this is where the entire story gets complicated. The immediate expectation, looking at a chart like that, is pure euphoria. This is a disruptive force in banking that is finally having its moment, crushing estimates and taking market share. But the reality is far more fractured. While the price tag is $29, the consensus analyst price target from nearly 30 firms covering the stock sits at just $21.29. That is not a typo. The market is currently paying a price that is nearly 30% higher than where the average Wall Street analyst believes its fair value lies. This creates an incredible tension, a massive disconnect between the market's narrative and the professional forecasts, especially as we stand just days away from their next earnings report. The common ground is easy to find. Everyone agrees SoFi's performance has been stellar. The company's last report, its second quarter results from back in July, was a blowout. They posted earnings of 8 cents per share when the street was only looking for 6 cents. They beat on revenue, bringing in $858 million versus an $804 million forecast. They added a record 850,000 new members, bringing their total to 11.7 million. Growth was accelerating, with adjusted net revenue up 44% and adjusted EBITDA up 81% year over year. They even raised their full-year guidance. This is the bull case in a nutshell. A high-growth fintech company firing on all cylinders, finally achieving consistent profitability and stealing customers from the big, slow, traditional banks. The expectation is that this is the new normal, and that the upcoming earnings report on October 28th will simply be a repeat performance, another beat-and-raise quarter that forces those skeptical analysts to capitulate and raise their targets. But the deeper reality, the one reflected in those bearish price targets, is a story of valuation and sustainability. The market is pricing in perfection. The challenge for SoFi is that it's no longer enough to just beat estimates. At a $29 share price, they have to crush estimates and guide significantly higher just to justify the current valuation. The bears, which include major firms like Morgan Stanley and Keefe, Bruyette & Woods, who rate the stock as underweight and underperform respectively, are not necessarily betting that SoFi is a bad company. They're betting that it is a good company, bad stock. Their thesis rests on the idea that the 171% gain in the last year has pulled all the good news forward. They look at the competitive landscape, the high-rate environment, and the sheer cost of acquiring those 850,000 new members, and they question if the long-term profit margins can ever be high enough to warrant a valuation this rich. This is the core conflict. Is SoFi a high-margin technology platform, or is it just a bank with a better app, subject to the same old cyclical pressures of lending and credit quality? This tension is visible in the recent trading action. That 3.31% jump on Friday wasn't an isolated event. The stock has been climbing a wall of worry all month, rising from the $26 level in mid-October. This is classic pre-earnings positioning. The bulls are loading up, anticipating another upside surprise. The volume confirms this. 53 million shares is high, showing real conviction and participation. But this run-up also raises the stakes. If SoFi reports anything less than a spectacular beat, if member growth slows even slightly, or if their guidance is merely in line with expectations, the air could come out of this balloon very quickly. The macroeconomic environment is also a major factor. The Federal Reserve's higher-for-longer interest rate policy is a double-edged sword for SoFi. On one hand, as a chartered bank, it can earn a higher net interest margin on its deposits. But on the other hand, stubbornly high rates can destroy demand for its core lending products, personal loans, home loans, and even student loan refinancing, as borrowers may be less inclined to refinance if rates aren't substantially better. For those who are new to the story, SoFi operates in 3 distinct segments. First is its lending division, the original business built on refinancing student loans for high-earning graduates, which is now expanded into personal loans and mortgages. The second is the financial services division, which is the one-stop-shop banking experience, SoFi Money, checking, savings, credit cards, and more. This is their customer acquisition funnel. The third, and arguably the most important segment, is the technology platform. This includes Galileo, which provides the back-end infrastructure, the pipes, for other fintechs to build their own banking products. The recent earnings report showed that the financial services and technology platform segments, combined, now account for 55% of total revenue. This is critical. The expectation for many is that SoFi is a student loan company. The reality is that it has successfully pivoted into a diversified financial technology platform, where its tech-driven fee-based revenue is growing at a blistering 74% year over year. This is what the bulls hang their hats on. This is the part of the business that, they argue, deserves a high-growth tech multiple, not a boring bank multiple. Now we have to talk about the short interest. This is a topic of huge debate on forums across Reddit and X. When you look at the data, you see a very large number. As of the last report, on September 30th, there were 103 million shares being held short of SoFi. This sounds massive. It's an objectively large bet against the company. But this is where investors need to be very careful and look at the complete picture. The first thing you must do is check the short interest not as a raw number, but as a percentage of the float. For SoFi, that 103 million shares represents about 8.78% of the free float. While that's not small, it is not the catastrophically high number you see in meme stocks. It's a significant but manageable level of bearish sentiment. The second and most important metric to check is the days to cover. This tells you how long it would take for all the shorts to buy back their shares based on the average daily trading volume. For SoFi, the days to cover is only about 1.8. This is extremely low. It means that if the shorts were wrong and the stock spiked, they could all get out of their positions in less than 2 trading days. What does this tell us? It tells us this is not a structural short squeeze setup. The shorts are not trapped. This is a fundamental disagreement, not a technical anomaly. You can also confirm this by looking at the short borrow rate, which is the interest rate funds have to pay to borrow shares to short. For SoFi, that rate is incredibly low, around 0.27%. It is cheap and easy to bet against this stock. This data is available on most major financial data platforms like Fintel or directly from NASDAQ. You should also check the failure to deliver data, which shows if shorts are having trouble finding shares. While SoFi had a small FDD spike in mid-September, the numbers are not at a level that suggest any systemic settlement issues. So, what is the short thesis? The 103 million shares short are not betting on a squeeze, they're betting on valuation. They are betting that the $29 price is absurd and that the $21 analyst target is correct. They are betting that earnings next week, no matter how good, cannot possibly justify the stock's euphoric run-up. They are the ones representing the reality side of the valuation argument. Do you think the 103 million shares short are smart money betting on a valuation pullback? Or are they about to get run over by another earnings beat? This brings us to the future outlook, which hinges entirely on the October 28th earnings call. The expectation is set. The market is pricing in a massive beat-and-raise quarter. The reality is that SoFi now has to clear a very high bar. The first number to watch will be member growth. Can they add another 850,000 or even 900,000 new members? Any slowdown here will be punished. The second will be the technology platform revenue. Can it maintain its 70% growth rate? This is the key to the high multiple valuation. Third, we must listen for any commentary on credit quality. In the last report, credit performance was improving with delinquency rates falling. In this high-rate environment, any reversal, any tick-up in defaults would be a major red flag for a lending-based business. The final guidance they provide will be everything. If it's merely good, the stock will fall. It has to be spectacular. The bull scenario is that SoFi delivers on all fronts, posts a triple beat, EPS, revenue, and member growth, and raises guidance substantially, forcing a re-rating from the skeptical analysts at firms like Morgan Stanley and driving the stock toward $35 plus. The bear scenario is that the growth in new member stalls, the tech platform revenue decelerates, or the credit outlook sours. In this case, the short sellers are proven right, the valuation argument wins, and the stock could easily see a 20 to 30% correction, pulling it right back down to that $21, $22 analyst consensus. This is a true battleground stock. Comment below with your own price target for SoFi after they report earnings next week. Are you in the $22 camp or the $35 plus camp? So, as we close, the story of SoFi is a perfect case of expectation versus reality. The expectation, fueled by a 171% run-up and a $29 price, is that SoFi is an unstoppable disruptive force. The reality, reflected by bearish analyst targets and 103 million shares short, is that it's a company with a dangerously high valuation facing a wall of impossibly high expectations. The bulls are betting on the pivot to a high-margin tech platform. The bears are betting that at the end of the day, it's still a bank, and no bank deserves this kind of multiple in this kind of economy. The tiebreaker comes in just a few days.